So Andreas, I've started the recording and I guess
Okay.
we're ready to go.
All right. So we're very happy to have Darrell Duffie here, who will talk to us about reserves were not also ample after all. Darrell, the floor is yours. Darrell will probably break for questions at various points, he tells me. After about 45 minutes, we're going to have a Q&A. If you have questions in the interim, please put them in the chat. I will monitor it and pass them on to Darrell.
Or raise hand.
Or raise the hand, yes.
Good. Thanks so much, Andreas. Thanks, Bjorn. Really appreciate the opportunity to speak at the Microstructure Exchange. This is completely new work with Adam Copeland at the Federal Reserve Bank of New York and with David Elin Yang, who's here in our doctoral program at Stanford University. And before I get started, I need to make the usual disclaimer, even though I'm not at the Fed, but because Adam is, and we're using, also because we're using Fed data, that anything that I say should not be viewed as necessarily representing the views of the Federal Reserve Bank of New York or the Federal Reserve System. So with that, let me just tell you what we're about. There's a long kind of wind up to this motivation for this research, but be patient. We do have some empirical results to offer. And I'm looking forward to your questions and comments. I pretty much know what I'm going to say, but I'm more interested in what you're all going to say in response to what I'm going to say. This project was motivated by the Fed's program of balance sheet normalization. If you remember, the Fed got a very large balance sheet after the financial crisis because of quantitative easing. And it kept getting bigger for a while, but then starting in 2017, the Fed decided that it would reduce its balance sheet to the minimum level commensurate with effective monetary policy. And you can read the FOMC minutes on that. Now, bringing down your assets means you bring down your liabilities. You let your assets mature and you pay off your liabilities, which most of which are deposits at the Federal Reserve by banks. So if you're a bank, you can deposit money at the Fed. Those are called your reserves or reserve balances. And as the Fed brought its balance sheet down, the amount of balances reserve balances of banks also went down. And the Fed said that it would keep reducing until the point at which tightness of reserves caused some increase in the interest rate that markets would use to price things like repos and other funding transactions. Repos meaning in our case, treasury repurchase transactions. So these are effectively, most of them, overnight loans collateralized by treasuries. And the interest rate on those overnight treasury collateralized loans is known as the repo rate. We're going to focus on some major market benchmarks for the repo rate, primarily SOFR, or the secured overnight financing rate. And what we're going to do is to see through changes in the behavior of repo rates and through the manner in which banks made their daily payments, that the Fed may have overdone it. Reserves were not as ample as they had hoped they would be. There was an accidental overshoot, at least in my opinion, and it caused some disruption, both in terms of the bad behavior of repo rates, especially in September 2019, but not exclusively then, and also other signs that reserves were not so ample after all, which is the title of our paper. So that's an introduction at one level. Let me now dive deeper into the background. So this is a chart showing the Fed's balance sheet normalization period until...
I don't think we can see his slides.
Okay, that's not good.
They seem to be stuck. Oh, there it is.
Okay, maybe it's just slow software. Thank you for noting that. So on the vertical axis of this chart is the reserve balances. These are deposits by banks at the Fed. The horizontal axis is our sample period, which takes us from 2015 through to the period after the COVID crisis, when balances shot way up because the Fed, for other reasons, unrelated reasons, had to rescue the treasury market and buy a whole lot of treasury securities, and they paid for those treasuries with more reserve balances. And of course, after that happened, reserve balances were definitely ample, more than ample enough. And in fact, we're getting to the point where they may be excessively ample, but that's not part of today's talk. The main part of today's talk is the period taking us down to the trough on this chart, which you can see is September 2019. That's as low as balances ever got, and that's when repo markets went kind of haywire in mid-September. And I think we're going to be fairly convincing that the reason that repo markets got very disrupted was simply that the balances were too low. The balances are broken into three colored segments. The blue segment are the major bank dealers that intermediate the repo market. So these are the 10 most active dealer banks in the repo market. Now I can't tell you who they are because those data, all the data are anonymized, but I think you probably know most of who they are. And they may include foreign bank offices of foreign banks in the US. And they certainly must include most of the household names in the systemically important US banks. But again, I don't know their names. The red segment are the next 90 banks of the 100 largest banks during our sample period by reserve balances. So red and blue together are the 100 largest banks. And as you can see, they have the bulk of reserve balances. And the green is everything else. The green is not in our data. We're not paying any attention to green because we think that the 100 largest banks are probably more responsible for what's going on in repo markets and the tightness of reserves for payments and so on than the rest. Okay, so here is an example of what happens when you have less than ample reserves. So I'm going to take a few minutes to go through this chart. Again, the horizontal axis is time, but it's focusing during the period of balance sheet normalization, which, as you saw, took place in 2018.
Sorry, I can't see the slides again either this time. Every time it moves, I don't think it gets updated. Is that just for me or to everyone else?
No, same here. It doesn't update yet.
Okay, so let me try to plug in again and do another screen share. Maybe it's just that there's too many data points in my slides. It's still not updated, right?
No, it's not updated yet.
Okay, so I'm unplugging and I'm going to do another screen share. Some of these charts have a lot of data, so maybe that's the problem. I've never had this happen before. If it happens again, I'll just deal without the ability to mark on the slide just by going directly to the. You have slides now?
Yes, we can see the slides.
Okay, and if this problem crops up every time, then I'll just dispense with my iPad and go directly to my laptop.
Okay.
Okay, what you should be seeing now is the behavior of repo rates during the period of balance sheet normalization, which is when the Fed brought down balances in 2018 and 19. The horizontal axis is time. The vertical axis is the difference between repo rates and the rate paid by the Fed on balances, which is called IOR, interest on reserves. Now, why is that spread relevant? Well, in an efficient market, those rates should be the same. There should be no spread because for banks, You can either put your money at the Fed overnight, or you can put your money in a Treasury repo overnight. They're both risk-free overnight investments, so they should have the same interest rate if markets were efficient. As you can see, they don't. And in particular, there's a lot of spiky behavior during this period of balance sheet normalization. In fact, in order to make the slide more visible, we truncated the spikes at 200 basis points, which is a very large violation of arbitrage. And you can see that among the points at which those big spikes occurred were in mid-September 2019, but they didn't stop then, and they didn't start then. That September date got a lot of headline news, and immediately after it, the Fed corrected and provided a lot of funding to markets. But even through March of 2020, when the COVID crisis hit, there were clear signs that there were not enough reserve balances, and repo rates spiked again. Now, of course, March was a huge shock, but at least in my view, there's evidence that reserves were not yet ample enough until after March. After March of 2020, the Fed bought an enormous quantity of treasuries, 1 trillion of treasuries in just 3 weeks, and now it's well over 2 trillion. And so that basically flattened the spread between repo rates and IOR. There was plenty of reserves, and there was just no issue with these repo spreads spiking. They've been as tame as a pussycat ever since then. This would be an opportunity if anyone has a question just about the data so far or about our motivation. Please be patient as I get into the story in a deeper way.
So there are no questions in the chat at this point. If anybody wants to raise their hand.
Okay, let's see if my slide works. How did that go? Am I on the next slide?
Yep.
Well, that's good. Okay, now I've added to the slide. Oh, by the way, on the previous chart, I didn't tell you, I put in 2 different time series for repos. One was the SOFR, which is the broad market average produced by the New York Fed. Let me go, better not move back. The broad average of the New York Fed is called SOFR, the Secured Overnight Financing Rate. It's plotted again here for the period from mid-2019 to late 2020. And the other time series I had on the previous chart was GCF, which is roughly speaking an interdealer rate. And all of our results hold, whether you look at GCF or SOFR, they are different. And so there are slightly different magnitudes. But in terms of the story I'm telling you today, other than on quarter ends where there's some capital requirement issues, all the behavior is pretty much the same, whether you look at GCF or SOFR. So we're going to look at SOFR unless I say otherwise. I also plotted on this chart the balances of those 10 largest repo active banks. And that's in blue. And you can see those balances were quite low in September 2019, and they actually hadn't changed much from the beginning of September 2019 to the beginning of March 2020. And so this is one of the, I think, marginal contributions of our paper, which is if you just look at total balances in the entire system, the Fed did increase those quite a bit after September 2019. But if you look at the balances of the banks that intermediate the repo market, they didn't really increase very much. In fact, they're about the same at the beginning of March 2020 as they were at the beginning of September 2019. And for that reason, I don't think it's all that surprising that there was another spike in mid-March when there was a lot of lurching for cash during the COVID shock to markets. Again, you can see that the spread stays flat and smooth pretty much after the balances climb way up. Reserves were truly ample after March 2020. So
So
Yeah.
Darrell, we have a question in the chat from Madhu. He asked whether or not the futures also captured the same rate or the same spikes, or if this was something isolated to the repo market itself.
Where you can see other spikes, for those of you that follow funding markets, is in the cross-currency basis. And there's a really good paper, in fact, let me cite it right now, by Correa, Du, and Liao, that showed that not only did rates spike in the repo market, they spiked in any market that Correa, Du, and Liao called reserves draining. Any market for which, when you're one of those large repo active banks, you're active in providing funding to markets by draining your reserves, rates did spike, and that happened in the cross-currency basis. But in terms of treasuries, well, that's not a funding market per se, it's an investment market, and there was a lot of volatility in treasury rates in March 2020, but that's unrelated to our story. Let me just summarize our main.
Sorry, can I ask one more question, because we're the microstructure people here. So maybe can you maybe go into a little more detail of how the mechanism actually works and how the spike would come about? Because one of the questions that I immediately have is there no way for, it seems to be a one-day spike, I think, in the data, right? Is there no way for the Fed to react instantaneously to this?
That's a good question. So the Fed did react as quickly as it possibly could, and it was very smart to have reacted quickly in September by flooding the system with more funding. But that doesn't necessarily stop the spike. First, the Fed has to notice that there is a spike, and repo markets, in terms of microstructure, I'm going to show you evidence that the rates are set pretty much early in the morning, and they set the color of the market for the whole day, because most of the heavier trades are done first thing in the morning. So there's a limited amount that you can do after the end of the day. I am going to talk a lot about the microstructure of what's happening in a few minutes. And I'm going to relate this whole story basically to early in the morning, you get a sense that there's not going to be enough reserves to make all of your intraday payments in a timely manner unless everybody else pays you for everything. And this is, you know, every kind of payment that you get for everything, not just repos. If you're not confident you're going to get paid early, then you're going to pay later. That has a nasty feedback effect. And moreover, if you can sense this is happening, you're just going to start charging a lot for providing funding on repo. Because why would you send money out the door at normal low interest rates if you think you're not going to have enough money to meet your payment needs during the day, or you're worried that you might not? So let me get back to a summary, just verbal summary, before we get to the key quantitative findings. So first, funding market liquidity does depend a lot on the ampleness of reserve balances. And as I said, that was already apparent in a paper that just preceded us by Correa, Du, and Liao. That's another Fed paper. Second, the opening reserve balances of these 10 large repo active banks are especially highly associated with repo rate distortions. And I think you've already seen that in the picture, but I'll show it to you through regressions and through probit work coming up. Third, low opening balances for the large non-dealer banks, the other 90 of the 100 largest banks. When they have low balances, they're paying the repo active banks later in the day. So I see Pete Kyle is here. Suppose he's over at PNC, which is another large bank, but not a repo active bank. And I'm over at JP Morgan. If Pete's balances in the beginning of the day are low, he's going to conserve his balances, pay me later than normal. I know that's going to happen. And so I'm going to quote higher repo rates because I'm not going to get, I'm worried about my balances being high enough. Third or fourth, if you don't have a lot of balances, then when there's a treasury auction that gets settled today, that puts a lot of extra stress on the dealer banks. Why? Well, because the Treasury Department requires that you pay for those treasury settlements first thing in the morning. So what's the implication of that? So if Goldman has to pay for a lot of treasuries that it got awarded, and it has to pay first thing in the morning, then it lost the optionality of when to use those reserves during the day to meet its other payment needs. So that basically takes the reserves out of the hands of the largest repo active banks. And those reserves get extinguished. They don't go somewhere else in the Federal Reserve System. They get eliminated because they go into the Treasury's account, which is not part of the Federal Reserve balances. So not only do you lose the balances, but you have to lose them first thing in the morning. So all of your timing optionality goes away in terms of intraday payment timing. There's some other results we probably won't have time for today because I want to finish on time, but it also turns out that quarter end capital requirements and treasury bill supply affect funding market liquidity and repo rates, but the channel for those, the channel by which those work is different. And if we have to leave something behind, I'm not that worried about leaving that part behind because it's not part of the main story, but it is quite interesting. So what did Jamie Dimon say about all of this? After that massive disruption in repo markets in mid-September 2019, on the next earning call, Jamie Dimon was asked by an analyst, why didn't you use all those reserve balances that you had to arbitrage those high repo rates? You could have taken money out of the Fed, where you're only earning a piddly little interest rate, and invested those reserves in repos and made a lot of money. And Jamie Dimon replied, as quoted here, I'll run through this, but basically he was saying, under new post-financial crisis regulatory requirements, we are expected to maintain positive balances all through the day. We can't run our balances down to zero because that would get us in trouble with our supervisors. So here's what he said. We have a checking account at the Fed with a certain amount of cash in it. Last year, and he was referring to 2018, we had more cash than we needed. So when repo rates went up, we went from the checking account paying IOER into repo. They did do the arbitrage, in other words. He said, obviously makes sense, you make more money. But now the cash in the account, which is still huge, it's 120 billion in the morning and goes down to 60 billion during the course of the day and back to 120 billion at the end of the day. That cash, we believe, is required under resolution and recovery and liquidity stress testing. So the story here is that the largest banks were worried that if they used their balances to arbitrage markets, they could run the risk that they wouldn't have enough to meet all of their intraday needs, and then their supervisors would be on their case, and you don't want to get a memo from your supervisor. And you're sure, if you're running repo or you're running payments, you sure don't want to get a call from your boss saying, what the heck are you doing getting us in trouble with the Fed? Pre-financial crisis, the banks were using daylight overdrafts to meet their intraday shortfalls in reserve balances. These are running negative balances during the day because you know you're going to be back to positive by the end of the day. After the financial crisis, those overdrafts went way down. One of the reasons they went way down was that there were a lot more balances in the system. But the other reason is that banks like JP Morgan didn't want to do overdrafts. And just to show you that there still was stress in the system, even though there was lots of balances, here we plot a simple scatter plot showing the relationship between the average daily balances of the top 100 banks on the horizontal axis and daylight overdrafts on the vertical axis. So there was, even though reserves were supposedly ample, there was still a strong relationship. Those overdrafts are most likely not by the very largest banks because, again, their regulatory requirements were quite strong. Here's a list of the three key regulatory changes after the financial crisis by which the banks were frightened about getting their intraday balances anywhere close to zero. The first one is called CLAR. Those are the comprehensive liquidity tests of the Fed's supervisory, which in quotes 2019 focused on intraday liquidity risk. They really wanted to know that the banks would not have a problem with having lots of balances. So the banks didn't use those balances. It was kind of like Charles Goodhart's famous remark about you can leave the train station and there's only one more taxi parked at the taxi stand. And you approach and the taxi driver says, "I'm sorry, I can't take you." There's a rule that says we have to have always at least one taxi left in the taxi stand. So you'll have to wait until there are two. So this is basically the story. Those reserve balances, even though they were supposed to be there for a stress period, they could not be used because the banks were afraid of using them. The second requirement, I'm not going to go into, it's Reg YY, also governs intraday liquidity exposures. And the third one, by the way, these were referred to by Diamond if you look back in the quote. The third one is called RLAP, Resolution Liquidity Adequacy and Positioning, which is a test to see whether you can meet your intraday cash requirements, even in an unwinding scenario. So these are resolution recovery requirements for liquidity. This is a slide simply showing what I mentioned earlier, that the repo market basically settles first thing in the morning at around 7 a.m. And I've talked to asset managers and dealers about this. Pretty much the market is set. Most of the balances, whether it's on a normal day or a crunch day, are being traded early in the morning in the repo market. Let me take a minute on this slide because it contains most of the main story of the paper, even though we have a lot of quantitative evidence to follow. Let's do the horizontal axis first. It's a little bit easier to explain. Because we want an intraday measure that gauges market rates early in the morning, we took the first 20 minutes average transactions rate from tick data that we got from Tradition, which is a repo trading platform for the interdealer market. So V-water sub 20 minutes means during the first 20 minutes of the day from 7 a.m. to 7:20 a.m., what was the average repo rate traded in the interdealer repo market against treasuries? Subtract IOER so that you get this distortion or arbitrage spread. And we measured it on a log scale so that you could see the big spikes without having to squint too hard. So the middle of the chart is at 1 basis point, then it goes to 16, then 256, and so on. On the vertical axis is a key variable that was introduced to the literature by Jamie McAndrews at the New York Fed and co-authors some years ago in several papers. And we're using it later as a key explanatory variable. And this is the time by which the largest repo active banks have received half of their incoming payments for the day. Let me repeat that because it's a mouthful. 100 on the vertical axis means that a dot located at 100, let's see if I can actually draw on this chart. A dot located at 100, like this one, means that on that day, the 10 largest repo active banks got half of their incoming payments 100 minutes later than normal. That's a stressful day because you're not getting paid as early as you normally do. Even early in the morning, you can somehow forecast that's probably going to be a tight day for reserve balances and you're quoting higher rates. And these red dots over here are the dates on which the repo rate spiked above IOR. And those are spiking according to SOFR. So there is a pretty, I think, strong evidence here that when you're getting paid late, you're also charging counterparties a lot more in the repo market. Now, why are you getting paid late? Let's go back to Pete's bank. Pete's over at PNC, is one of those other 100 largest banks, and his balances are low today. Well, that means that JP Morgan and company, Goldman, assuming those are the large repo active banks, they're going to get paid later than normal because Pete's not going to pay them if he doesn't have as much balances until later in the day. The horizontal axis here are the other 90 large bank opening of day balances. The vertical axis is again for the 10 largest repo active banks. How much later than normal are they receiving half of their incoming payments? And in this case, the relationship is very tight. As you can see, the R squared is 69%. And notably, the red dot right up in this top left corner is the big crunch day, September 17th, 2019. So it was on that day that the 10 largest repo active banks got paid as late as they ever did in our sample period. And the other 90 large banks had the lowest opening day balances that they ever did in our sample period. The other record high date, which I just circled, is the date in March 2020 when COVID hit. That's March 16th, 2020. On that day, reserve balances of the 90 large banks were reasonably low, and the largest repo active banks got paid record late, and repo rates spiked. Okay, so a quick look at a regression and then a probit. So what does explain the timing of payments to
Darrell,
large...
if I may interrupt you, I think this may be a time to have a quick break. Evangelos had a question. He said it's the discussion on intraday liquidity usage seems highly relevant to the ongoing efforts in several central banks around the world to update their liquidity saving mechanisms that allow large value payments to be made by recycling liquidity. Would you, this is more of a statement than a question, but maybe there's something to comment on for you.
Yeah, the Bank of England has been doing that. And I read a little bit about that, and it was remarked upon the last time that I spoke to anyone from the Bank of England. And I know Evangelos will know about that. So the Fed is not doing this. Evangelos, maybe if you could unmute, or you could be allowed to unmute and just briefly state what that intraday liquidity savings mechanism is.
Hello, Darrell. So yeah, well, thanks for your comment. I just just for the record, I got to say that I have left the bank now. I'm an academic, so I'm with the University of Nottingham at the moment. But the idea is that whenever you make payments in these large value payment systems, what happens is that if you need to make a payment, everybody has an incentive to make that payment later in the day. And the reason for that is that you can always receive a payment earlier on, and maybe you can use that payment in order to make your own payment. In other words, you have an incentive as a participant in those systems to wait a little bit until someone else makes a payment to you first. That way you can economize on your own liquidity that you use. And the problem with that, of course, is that everybody has that incentive, and in equilibrium, everybody gets to delay their payments, and you may end up with a gridlock in the payment system. So what these liquidity saving mechanisms do is they try to incentivize participants in those systems to make their payments earlier on. And the way they do that is they condition payments, outgoing payments upon incoming payments. So if I need to pay a few billion pounds or dollars or euros, what's going to happen is this payment is going to go into a queue. So I'm not going to be making the actual payment yet, but the payment will be released the moment that there's an incoming payment from someone else. The important thing about this system then is that it incentivizes participants to submit and release their payments early in the queue. That means that all of these payments can be processed much faster. If you did not have such a mechanism, everybody would just wait for everybody else to make the first move, right? It's called actually in economics, I guess someone would call it a volunteer's dilemma. And then you would have these issues that I just described. So thank you very much for the opportunity to explain that.
Good. Okay, so
Can I ask a question?
there's another.
Yeah, Mal. Can you hear me?
Yes.
Darrell, so two very quick questions. First one is go back to your Jimmy Dimon example. So what drives the large intraday fluctuation of the reserve balance? And the second question is related. Will there be a big difference between dealer banks and non-dealer banks?
Okay, so first, what drives a large fluctuation? Well, I already mentioned treasury issuance clearly causes a big change, because when treasuries are paid for, they have to be paid early in the day. Corporate tax payments, the use by the treasury of its own account at the Fed, whether it takes more in or sends more out, that has a big effect. Those are probably the three most notable, but there's a lot of randomness. It's not predictable on any given day exactly what's happening. At least randomness across the future. On a given day and early in the morning, you might have a good idea by then. And on the second question, what distinguishes the largest dealer banks from the other banks? There's two factors. Number one, the dealer banks are intermediating funding markets, so their reserve balances is more critical. And you might say, well, it doesn't matter because they can buy or sell balances at any time. It's not that inefficient a market. The second distinction between the largest dealer banks and the others is that the largest dealer banks are the ones that are subjected to these regulatory requirements for globally systemically important banks. And the other large banks are subjected to either lesser versions of those regulatory liquidity requirements or none of them. So those are the two main distinctions. In the interest of time, I'm going to rush ahead because I want to leave more time at the end for discussion. What I want to do in this panel of regression results is to motivate some of the points that I've already made. And I want to be cautious. There's endogeneity everywhere. What I'm showing you is association, not causality. This is not a structural model. And in fact, if we have time, I can make an argument that the association results are understating the structural relationships because of endogeneity. But having said that, let me point out that indeed, as the large repo active dealer balances go down, the spread of repo over IOER, that's the rate spread that we're talking about, goes up. Oh, sorry, this is not, here we're doing a regression of timing. Timing of payment to dealer banks. So when dealers have low balances, everybody's likely to be paying everybody else later in the day. That's not good. Look at this variable. For that one, for the balances, it's only an R squared of 0.14. If you look at when dealer banks get paid as a function of the other large bank balances, that's a 69% R squared. That's the regression I actually showed you in the scatter plot. I wish I had time to show you more of this, but I'm going to jump ahead because otherwise we're going to be out of time. Let's talk about what does explain distortions in repo rates. Low dealer balances explains, that has an R squared of 12%. When you add in a quarter end fixed effect because of regulatory capital requirements, that goes up a bit. But when you include the median time by which the large dealers get paid, that's the intraday stress measure for payments. The R squared goes up to 36%. And notably, these coefficient estimates are highly statistically significant. They're, the T statistics are in the order for this one of about 14. I'm going to jump across to, in the interest of time, just focusing on the issuance of Treasury securities, particularly coupon securities. Those are the notes and bonds as opposed to Treasury bills. When the Treasury issues coupon securities, there are large supply and demand effects in the market for overnight repos. One of the supply effects I already mentioned, which is the banks have to pay for those and they have to give up reserves. Those reserves disappear from the system. The other effect I mentioned is that they have to pay first thing in the morning, which adds stress. The third thing I didn't mention is that once they take down these Treasury coupon issues, they are sent out into markets for financing, and that places extra demand for repo financing, which also elevates rates. I'm watching the time carefully. What explains the incidence of spikes in repo rates? So we enumerated in our data all of the days on which one of our repo rate indices jumped at least 30 basis points above normal. That's a spike. We're calling that a spike because 30 basis points is an aberration in these kinds of markets. And then we did a probit analysis estimating the likelihood of a spike based on various factors. And the key factors are this median receive time, that is later receive time is going to incite a spike in rates. Low opening balances will incite the issuance of coupon securities will incite, and a quarter end will incite a spike in rates. So let's just go through one example. It's a 1% chance of a spike, according to a probit estimate. When you're getting a normal, that is no difference between, you're at normal in terms of your median time of receiving balances. Your balances are at a sample average normal level. The Treasury has issued today the average amount of Treasury coupon issues, and you're not at a quarter end. So this is like normal time, no stress, 1% chance of a spike. If you go to later than normal balances by 1 standard deviation, which is 58 minutes later than normal, the likelihood of a spike doubles to 2%. If you then reduce balances by 1 standard deviation, which is $150 billion, the likelihood of a spike doubles again. And if you are also on a day on which there's 1 standard deviation increase in the amount of coupon issuance, which brings you up to a $91 billion issuance, but you bring back balances, you bring back the receive time back to normal. You're not getting late payments. Again, it's about a 4% chance of a spike. If you stress all 3 of these indicators, the likelihood of a spike goes up to 11%. And then if you're at quarter ends, well, you can read the numbers. It's getting kind of stressful. This is my last slide, and then we'll open it up for discussion. Here are some, this is not a policy recommendation paper. This is just an academic research paper, but policies have been recommended to deal with this problem. And I just want to run through the main policy recommendations that others have suggested. The first one is, well, let's have really ample balances, and then we'll get rid of these problems. And according to our results, you really would get rid of these problems if you have enough balances. And it seems as though balances above 650 billion for the 10 large repo active banks is probably enough. 650 billion. When you get below that, you're taking your chances. However, various authors have written that there are trade-offs with having very large reserve balances. So one paper by Cavallo et al. Says, well, if you have very large balances, then you're going to have to pay the banks for interest on all those balances. That means your taxpayer money is going to the largest banks. That's not going to be very politically attractive. And also it's expensive for the Fed. So if you're running right now, the Fed has something like 4 trillion-ish of balances. If interest rates were to go up, as Larry Summers and others might suggest, that's a lot of interest payments by the Fed. Another comment by Kobus and Nelson says, well, if you flood these banks with balances, then they have to pay capital requirements on all those balances. They have to have capital to backstop all those balances. And those of you that are economists might say, well, you don't need capital requirements for reserve balances because they're risk-free. There couldn't be anything with less risk than reserve balances. But nevertheless, there are regulatory requirements, pretty stiff ones, for holding capital, even for assets that are reserve balances. And some have mentioned that if you allow the Fed to have take a lot of deposits, then they're going to have a lot of funding. They could spend that funding for fiscal purposes. And that would run counter to the separation between fiscal and monetary policy. The second option that has been mentioned by many is to have the Fed set up a standing repo facility, which would offer to a large set of market participants funding at a small penalty above IOR. Now you wouldn't have this kind of a crunch because anybody that's in a large set of counterparties could go to the Fed and say, well, rates are spiking. Would you lend me money at 25 basis points above IOR? I'd be happy to take that. The Fed would say, sure. And that would basically chop the top off all these spikes at 25 basis points. A third proposal is, to let the last taxi at the taxi stand leave if there's a need for it, which is Charles Goodhart's metaphor, meaning why have all these intraday liquidity requirements if the banks are interpreting them as I cannot use my balances even to meet a stress. So try to destigmatize the use of these intraday balances, let the banks use them for liquidity purposes, encourage them to use them on stressful days. And by the way, I'm not suggesting the Fed is ignoring that. It's the fact that the banks themselves are worried. It's not necessarily that they're being instructed by the Fed, but rather the banks don't want to run counter to their supervisors. And the fourth option, which has been mentioned, is to increase the incentives for using daylight overdrafts and increasing the incentives to use the discount window to get additional funding. Both of those are stigmatized right now. So banks, even if they're encouraged to do that by the Fed, they don't want to be the bank that's written up or discussed over dinner as the bank that had to go to the Fed or had to use a daylight overdraft, especially the largest banks. So that's the end. I'm a couple minutes past what I forecasted, Bjorn. I'm sorry about that. But we can have at least a few minutes for discussion.
Oh, this is perfect. So there's a number of questions that have already come up in the chat. Let's start with Davide. He asked that, did you see any effect on repo market functioning and spikiness after the Fed's relaxation of what counts towards the SLR ratio?
So as Davide hints, in the COVID impact month of March, at the end of March, the Fed eliminated the supplementary leverage ratio requirement for reserves. By the way, that's coming back again because it's the exemption is just about to expire at the end of this month. But the hard thing is that it's difficult to measure the effect of that because at the same time, the Fed flooded the system with additional reserve balances. So it's hard to separate one from the other. I think it had a moderate effect, and in part, that was because the FDIC did not go along very quickly with that relaxation. So even though the bank holding company was exempted from that capital requirement, the bank itself, which holds the reserves, was not exempted for an additional month. And by then the situation was under control.
So I would, so Joel has a number of questions, but I noticed before that Pete has unmuted himself a few times. So I was wondering if Pete was, Pete is shaking his head. Okay, good. So then we should go to Joel's question. So Joel says that the spikes in the SOFR IOR seem to be substantially lower than the GCF IOR spikes. So the question is whether or not the SOFR calculations smooth over time, or if the SOFR market is smaller than the GCF market.
Okay, so SOFR includes GCF as a component, and it is true, Joel. And by the way, Joel, I really enjoyed your microstructure exchange seminar last week. That was fabulous. I learned a lot about the foreign exchange market. Yeah, so the GCF market is a component of SOFR, and the spikes in GCF are larger. And I think it's for a number of reasons, one of which is that the marginal provider of liquidity as a lender in the GCF market are these largest repo active banks. Whereas in the other components of SOFR, like tri-party repo, the largest repo active dealers are borrowers of money. So if you think about the willingness that they may have to borrow at high rates versus lend at high rates, you might expect that there would be a spread that would open up there. On average, there is a spread even on a normal day. And particularly on spiky days, the largest banks are going to look after their own needs first, and then only after that on-lend some of the reserve balances to the other smaller dealers in the GCF market. That's the way I look at it anyway. And there is some evidence of that in a dissertation by Jonathan Wallen at Harvard, where he looks at the cross-currency basis and shows that the dealers apparently exercise a lot of market power when there's a shortage of balance sheet at the end of quarters.
So then Madhu has a question, which is, could SOFR market shocks have broader financial stability implications due to adverse impact on cap requirements, and hence the Fed needs to be more cautious in liquidity management? And I'm going to add a counter question, which is, so presumably, given the system is organized in a particular way, there's an advantage to it. So presumably, this is just the cost of it. Is it worth thinking about this?
So when you say this, Andreas, cost and benefit, which this are you thinking about?
Well, okay, so I have so I'm known as the blockchain goon here in this crowd. So, but what I'm thinking of when I listen to this, I'm wondering, if we were to, build the system from the way this market works from scratch, would we actually choose to do it the same way as we have it now? Or is there a better organizational way where you, for instance, pool liquidity by all banks together, where maybe you have atomic swaps as opposed to, having delayed payments, so that these discrepancy of when you get paid and when you have to make a payment goes away? I can think of any number of ways how the frictions that are built in the infrastructure could cause these problems and could be eliminated by a better market organization. And so what I'm trying to think there is, well, this is, so the way with the frictions as we have it, the way how we have the intraday liquidity measurement is something that we want. And maybe the spikes in repo rates under certain circumstances is just a side effect cost that we just have to live with.
Yeah, no, I don't think we have to live with it. And I think there are infrastructure changes that could improve the situation, like central clearing in the treasury repo market, which would benefit the largest repo active banks by netting down their long versus short positions so that they have more balance sheet space. With respect to the payment timing, however, I've actually started to do some work on this. And my initial theoretical musings suggest that it could go either way if you use smart contracts for payment timing and blockchain. And I can explain that maybe at more length. You and I could have a virtual coffee sometime, and I can explain a why that is, but it's in part related to the fungibility. When you don't use smart contracts, the degree to which you have substitution options that mitigate spikes, intraday spikes, and those substitution options for timing go away when you have smart contracts, because then your repo settlement has a label on it that says, I am going to settle at 3:15 p.m. come hell or high water, and nothing now can change the blockchain instruction on this repo. Whereas if there's no such smart contract for payment timing, you may lose that. Now, it could go the other way, because as you add settlement timing smart contracts with blockchain, you get more towards complete markets. And complete markets are more efficient. So this is a longer conversation, I'm afraid, but it's a really interesting one that I'm working on.
I'm happy to hear more about it. Cameron, how about you?
Hi there. I enjoyed the talk. So I don't know very much about banking and repo markets. I find them very confusing, and there's lots of like hierarchies that are troubling for me to think about. So like, what's the end result of like huge spikes in repo rates? Like, does that hit lending? Is that fine? Like, cause like, you know, like when you see like quarter end stuff where banks have to have huge reserves, right? There's these huge spikes in like arbitrage opportunities. And the reason is that all the people with the capital are not going to do the arbitrage because they need it for regulatory reasons, right? So like, what happens like if repo rates are super high?
Okay, so that's a question I get quite a lot, and it's related to questions about, you know, why is it a problem that the cross-currency basis goes out of whack? You know, what's the big deal? So here's the big deal in my view, and it runs across several areas. One is monetary policy transmission. The Fed can dial in the Fed funds rate reasonably accurately, but the Fed funds rate is kind of a wart on the surface of money markets these days. It's just a little thing. The repo market is a $2 trillion a day market. And if it's not operating smoothly, you know that the Fed's monetary policy is not getting to the real core funding markets properly. And so it's part of the Fed's mission that it actually, when it says we want overnight risk-free rates to be at whatever, 1%, they really want them at 1%, and they want the repo rates to be close to 1%. And when they spike, they're not achieving their goal. That means it's borrowing money is more expensive than intended by the Fed. And you're not getting the people are not borrowing money to the extent that they would if markets were efficient. So it goes towards monetary policy transmission. It also goes to financial stability. If you noticed the close relationship between intraday payment timing and spikes in repo rates, both of those are suggesting that on days where there's not enough reserve balances, the system is not operating smoothly, and there could be a freeze up, as somebody already mentioned, a gridlock in which nobody wants to pay anybody until they've gotten paid, and therefore nobody gets paid. And you might say, oh, that'll never happen. Well, it has happened. It happened on 9/11 because people were worried that now that Citibank was off the grid, that money wouldn't flow, so nobody was paying out, and the Fed really had to push hard. If the Fed had not moved very quickly, that could have been a gridlock. There's a paper on that by Jeff Lacker. And there's other papers by Jamie McAndrews and collaborators that show that you could have a freeze up if the Fed is not really smart and kind of do a manual override on the availability of funds. So whether from operational problems, like Fedwire went out the week before last for a few hours, that would definitely cause people to worry. Whether it's from low reserves, I think you want to try to mitigate having these disruptions in markets, and I think that's what the Fed's intention is. The Fed never
Thank you very much.
These spikes. They just happened.
Okay, Albert, how about you?
I hope you can hear me now, Darrell. This was, I'm always learning, in your talks. There's one thing that crossed my mind when you were talking about the Fed and moving quickly to when it sees trouble coming in the repo market. One thing that comes to mind is the volatility of payments, and if that, so the second level moment, if the volatility of payment is something that's sticky, that's autocorrelated, this might be a way for the Fed to see it coming. You see, if this starts to creep up, the volatility of payment in the system, people might need a bit more funding to make sure that everybody gets paid. Is that something that's on the radar of the Fed?
Yeah, Albert, are you skating on a canal?
No, I'm actually at the soccer field because I have to get my son. This is very unfortunate timing of the of this, but I'm doing everything I can to hear your talk.
I've been
And
reading.
on that note, Darrell, maybe you can stop the screen share so we can actually see Albert's game in the background.
Yeah, good. Good idea. Stop share. Good. Oh yeah, now I can see. I had this image of, because I read that that it's been cold temperatures in the Netherlands, that you can now skate on the canals.
Yes, twice in a decade that we can skate. Yeah, we did skate for a full week, the whole country.
So yeah, in answer to your question, Albert, the Fed is all over this. They have a lot of, especially at the New York Fed, a lot of research papers that are studying how intraday payment timing works. And Adam Copeland is my collaborator, has worked on that. Jamie McAndrews, Simon Potter, David Sky, many others have written a lot of papers about, particularly about strategic complementarity and payment timing. So the fact that banks pay out based on what they receive, which is what Evangelos.
That I understand, that you talked about. But one step ahead of that is all of this timing is an order of magnitude larger a problem if the total payments in the system that have to be made is creeping up. So this might give you another way to monitor potential stress on the system.
Yeah, and I have done that. There's a very tight R squared. In fact, I showed you a chart, which we're not on screen share anymore, but there's a chart that has a very close relationship between balances and late timing of payments. The R squared is 69%. So
Okay.
it's definitely the case that you want to have lots of reserves so that you get payments done promptly. And some people have asked me, well, why do we care as long as you get your money by the end of the day? Well, a lot of people care about that. There's counterparty risk. If you're not sure you're going to get paid early in the day. There's the fact that you need to use the money to pay somebody else, and you have a small number of reserves that have to be paid multiple times a day. Some days you get a lot more payments than there are reserve balances in the system, twice as much or 3 times as much. So they have to make their way around the system several times. If there's not enough balances, the velocity gets too high to manage in terms of transactional timing.
So I'm going to read those papers, Darrell. Thanks.
I should briefly say we're already at 12:05. Darrell has kindly agreed to stay a little longer till 1/4 or so. For those of you who feel like this, so we're going to continue the discussion because there's still some outstanding questions. But for those of you who feel that that we go running overtime, let's say the official part of this session is now over. But Darrell, you have as I said, you agree to have more questions, and Gerardo ask a question and he wants to ask that in person. So let's go move on from there.
Thank you very much. And thank you, Darrell, for your insightful presentation. I'm always learning a lot every time I see a presentation of yours, and this was not exception. And I was wondering whether your data allowed also to say something about a possible substitution effect across repos with different maturities. For an example that I had in my mind was if some participants could stop lending cash at longer maturities and shift some of that to overnight repos. For example, when the volatility of the payments in the system is going up, and that's because they may know that some sudden potential payments requests that could come up, and for this reason they want to get prepared. And for this, they want to have overnight payments that could roll over and use the cash to pay these obligations. And I was wondering whether you see some dynamic like this with your data that can help to explain a sort of substitution effect across maturities in the repo market, or maybe not. I'm happy to engage in the discussion later if you want to shed light and help me to understand this.
Gerardo, that's a very insightful point, but we don't get to see term repos in our data. But everything that you said is consistent with what I know about the repo market. There's a lot of substitution from term to overnight in order to increase flexibility. Also, when across quarter ends, foreign banks do not like to do term repos because they have capital requirements that bind at quarter ends. So in the Eurozone in particular, term repos are unpopular at quarter ends. That puts extra stress on repo financing in the US.
Thank you.
So then Cindy Pan has a question. Cindy, do you maybe want to ask it in person?
Sure, I really enjoyed the talk, but as I was looking on that chart with the spike probabilities, I noticed that when the coupon insurance increase a standard deviation, when they know they need to issue more coupons, why don't they decide to like change the timing or spread it throughout the day to make sure that the spike probability can decrease, or people can make payments on those and purchase it throughout the day if it's an option?
Yeah, so this is a really interesting question. And I actually talked to people at Treasury and at the largest banks and at the Fed about this issue, about why the Treasury Department wants to be paid first thing in the morning for Treasury issuances. And it's not clear to me why. I never got to the bottom of this. I think if you ask people at the Fed or Treasury about this, they might not want to share all of their inner thoughts about whether this is a good idea or not. It's, for some reason, it seems to be, I don't know, the right word is sensitive, but the Treasury just wants its money early in the morning. As far as I could tell, they could run up the TGA account by an extra 50 billion so that they'd always have 50 billion on balance more, and then take the money later in the day and allow the reserves to circulate in the market. But I honestly don't know why the Treasury wants to be paid first thing in the morning.
I see. I just think that the option is there, but they're not utilizing that option.
Yeah, yeah. I mean, there's no legal requirement as far as I know. It's not in the Constitution that they have to be paid first thing in the morning. But you know, if the Treasury tells you that if you're going to participate in the auction, you need to pay us first thing in the morning, then you're going to pay first thing in the morning.
Well, maybe some answer can be if you look at the old TV show Yes Minister. There's a nice explanation about what the Treasury, it's the UK Treasury, does. What their objectives are. Maybe that gives you some hint of what. So they have particular views on what they do.
Yeah, I mean, if the Treasury tells you you're going to do something, then you're going to do it. So
And
so
you
I
don't
have.
think
Well,
that
sorry.
might be changing anytime soon or sometime in the future?
Not that I know of, but it's not critical if there's a really truly ample reserves, because then this problem doesn't persist. So the easier way to fix this is just to have lots of reserves.
That's true. Thank you.
So I see no more questions in the chat. If anybody else has a question, you should raise your hands or just unmute yourself and ask. Is Joel, go ahead.
Thank you, Andreas. And this question, perhaps it's appropriate for a microstructure workshop, but I've always been kind of vague about the actual trading mechanism in this market. So we have a platform that's called Tradition. Is it a limit order book? a bargaining protocol of some kind? Just how does it work?
Okay, so Tradition operates in the interdealer market, and it's a RFQ type of platform. There's no limit order book, or you can just ping an individual dealer and ask for a quote. There's no rules or regulations about multi-dealer. And you could also stream quotes as a dealer to those that might wish to trade with you. There has been discussion about having more like a central limit order book market, which exists in Europe, but it hasn't happened in the United States. There's nothing like that. There are other trade protocols that are used in the repo market. There's BrokerTech, which does have, well, actually, I shouldn't be too certain, but I'm pretty sure that they have a limit order book market for overnight treasury repo, general collateral. Don't take my word for that. And then most of the market that's not in interdealer is doing it bilaterally by calling or doing a screen-based query for quotes from the largest dealers.
One clarifying question. Is it your impression that price transparency is pretty good? That is, if I go into the market, do I know what prices have been recently?
Well, if you have a Tradition screen or a BrokerTech screen or a Bloomberg screen, you can see current quotes, but most of those are indicatives.
Okay.
Price transparency is medium low in this market. There's no, I mean, we had to really work hard to get the Tradition data. I mean, I can tell you some stories about how hard it was to get those data. So post-trade price transparency is very, very low. And pre-trade price transparency is also very low. But SOFR has improved a lot. By the way, the Office of Financial Research tried to scrape as much data as they could, and it took a lot of work for them to get medium coverage of the market, even as a regulator. So it's a relatively opaque market.
Thank you.
Is it a high volume market, or is this, because if it is RFQ and interdealer, then, or by phone personal, then it seems like really low activity levels normally. Could that be a problem?
Well, it's a more than $2 trillion a day market. SOFR alone is $1 trillion a day, and they don't cover the whole market. So I think there's plenty of volume.
Yeah, sorry, maybe I meant transactions then, not volume.
Number of transactions is also very high. And we have tick data from Tradition, which covers only a small part of the interdealer market. And it's already pretty, quite a few. I showed you the number of quotes, I think, or maybe I showed you the distribution. I can't remember which, but it's quite a thick market for the early part of the day, at least.
Right, are there any other questions left? All right, since nobody raised their hand, Darrell, I want to thank you from the Microstructure Exchange and from the audience. This was an excellent talk. I learned a lot of new things about the repo market. I think I can speak for most people here. So thank you for that. And thank you everybody for attending.
Thank you so much, Andreas. Thank you, Bjorn. Thank you, everybody. It's a lot of fun. Now I have to get ready for my morning class.
Thanks, Darrell.
Thank you.
Bye-bye.
Bye.